Zillow's latest housing price predictions say we're heading toward another double digit appreciation rate over 16% again this year. But today, I'm going to go over data that I believe suggests we are already seeing a flattening of home prices and maybe on the verge of more listings coming to market in the next couple months. That's all coming up right here. Hey, thanks for joining me today. I'm Rick Harrison with MVP Realty in Southwest Florida, and today I'll show you the latest updates in the local market and mortgage rates, as well as some key data that suggests the market may not be as hot this year as the experts are saying it will be. Plus, the wall of worry grows this week with economic volatility and global tensions rising. So let's dive on in and see what this week's data is suggesting. All right, so we got a lot of information to go over this week. Let's get started right away with the 7-day market update. We're comparing last week's housing data in the MLS to this week's. So as of last week, we had 680 new listings come on the market. This week, we're at 715. That's up 5%. That's always welcome when we see new listings coming on the market, especially when we see, like this week, solds went from 720 last week to 721 this week. Really no change there. So when we see new listings come on with the solds staying the same, that's always good news. The other side of this news is pendings did go up this week, meaning 3% up from 1204 to 1244 this week. That's an additional 40 homes that went off the market under contract. But still, with new listings up 5% and pendings only up 3%, we still had a net gain of 2% there, as we're going to see right here in the listing breakdown, total inventory breakdown here. Single families went from 1866 last week to 1867 this week. That's only a gain of 1, but still that's positive. We've been seeing pretty high negative numbers over the last several months. 2 weeks ago, we had 100 listings go off the market as single families, a net loss of 100. So that's good news, a positive 1 there. Condos, we actually gained 39. We went from 812 last week to 851 this week. So we had a net gain in single family and condos of 40. Again, just to reiterate, condos does include manufactured homes, townhouses, high rises, different things like that. Everything except for the single family home in the residential section. Moving on to the multifamily investing. Last week we had 79 listings on the market. This week we're at 75, so we lost 4. Again, this week we are still continuing to track foreclosures. Last week we had 25 new foreclosures come on. This week we're at 26, so we did gain 1. This is net overall, a net gain of 1. So a few did go off the market, a few more came on the market, so we still have increased by 1. I think those numbers are going to continue going through now that the moratorium is over and has officially ended. Some of those foreclosures are coming back on the market now, and we're actually going to be taking a look at one of the stories that shows those numbers. Moving on to the interest rates for this week. NerdWallet has the 30-year fixed rate interest rate going from 3.924% last week to 3.941% this week. That's up 2 basis points. Bankrate has their average going from 4.19% last week to 4.25 this week. That's up 6 basis points. So both of them now right around the 4% range. Obviously, Bankrate quite a bit over 4.25%. So with those rising interest rates, we did see last week a slight decrease in the interest rate, but that's back up now that the market has sort of recovered, and they're not as antsy as it was when we first found out about the Russia-Ukraine tensions and them entering into Ukraine. Let's start off with our first story. The National Association of Realtors in January, pending home sales dropped 5.7%. So that's the year-over-year transactions actually decreased 9.5%. That small decrease could also be due to the lack of inventory that we have. With less homes on the market, less people are actually buying them because they're just the numbers, the pure volume of it. So that could have contributed to it, but it is something we want to keep an eye out on because if this trend does continue and we see that again next month for the entire rest, going into March, we see that for February as well. This could be the beginning of a trend. Yun, who is the National Association of Realtors chief economist, he stated as quoted, "Given the situation in the market, the mortgages, obviously home costs and inventory, it would not be surprising to see a retreat in housing demand. So as I said in the beginning of this video, Zillow actually upped the ante and went from, I believe it was a 12% prediction of appreciation this year to a 16%. So they're actually upping it more than they were before. I think Yun right here is on track with saying that the housing market will actually start to retreat. The demand will actually retreat a bit. Other factors that are going to be affecting this is obviously going to be the global oil supply, the tensions and issues going on in Russia, Ukraine right now. Both of them are major exporters of oil. And the sanctions now have increased to include the SWIFT banking system. So we're going to have to see how this all plays out. But if oil prices do rise, I believe we are going to see inflation numbers come out higher than expected again. We were at 7.5% before. I think we're going to be seeing it closer to probably, I want to say 10% this time. That might be a little high, but I do think we are going to see, things heat up a little bit and ramp up more. National Association of Home Builders also for January said that new home sales were lower as well. New home sales fell 4.5% to 801,000 seasonally adjusted. This part of this is obviously due to supply chain issues and the cost of material increases, which have contributed to adding about $25,000 additional to new home prices. The higher mortgage rates will also slow home buying demand over the course of 2022. So this is another contributing factor. And then new single family home inventory was up 34.4% year to year, rising to 6.1 months of supply. So just to put that in comparison, the resale market, which is homes that have already been built and are being resold, we're at about 1 month of supply there. So for the new home construction to be at 6.1 months of supply, that's actually really good news. But again, that's just considering all the homes that are in the pipeline. That is not counting all the homes that have not been built yet. So I'm sorry, it does count all the homes that have not been built yet. So that's all the permits as well. Moving on to the next story, mortgage applications decreased in the latest MBA weekly survey. So mortgage loan application volume decreased 13.1%, which is a significant amount. That's just week over week. So that's from last week to this week. And then in addition to that, the refinance index decreased 16% week over week, which is 56% lower than year over year. So quite significant decrease. Obviously, a lot of people refinanced last year because of the low rates. Now that the rates have started to move up, for many people who already have refinanced, it doesn't make sense to do it again, obviously. But those who were considering it now are seeing the higher interest rates. They're probably getting to a point where it's comparable to what they already had if they bought in the last several years. So, but that's the lowest level since December 2019. So, just to give you a breakdown of that, where people are actually putting the applications in, FHA share of total applicants increased 8.7% and VAs increased 9.9%. So again, with interest rates rising, home prices already being super high, a lot of people are getting priced out with the conventional mortgages where you need to put 10 or 20% down in most cases. That makes the FHA and VA loans a lot more attractive to buyers. It allows them to put less money down and also have money left over to complete their closing costs and still be able to purchase a decent sized house in an area that they're looking to buy. So that is why I believe those types of loans, FHAs and VAs, have increased in the recent months. Also, right in line with that, with the decreases in mortgage loan applications and refinance applications, mortgage businesses are seen laying off thousands as volumes drop. So employment in the real estate and mortgage industry increased by 50% over the last 2 years to around 130,000 new jobs. So with the amount of applications decreasing, that means that there's not as much work. It means that people are going to need to start laying off their lenders or their agents. So applications to refinance mortgages have fallen about 45% in the last 6 months. One of the things that I thought was a little bit scary in this article was that the lenders in general are trying to find more work for their staff. So they're starting to lower their standards a bit. Now, this was a little bit eerie because it reminds me of 2008, where standards were low in lending practices. Now that they're trying to lower them, I know it's only a little bit, but this is how it kind of starts. So that kind of had me worried a little bit. But Freddie Mac fell to 733 for a credit score versus 750 a year ago. So that's where the standards fall a little bit. They're allowing lower credit scores to get credit. We'll have to keep an eye out and see if that does continue, because that could be a signal that there's some fishy things going on in the market. Forbearance requests and reentries increase as exits hit record lows. So obviously, everyone understands that the moratorium for mortgage forbearance, has ended. We've been hearing lots of reports that those who were in forbearance programs have come up with a payment plan, or they put it at the end of their mortgage to pay off at the end. But the forbearance plan stages, 59% are in forbearance extensions now. So out of the amount of people who were in forbearance, 59% have asked for extensions. 13.7 are re-entering or asking for extensions, or both. So that's almost 70 to 75% of the people who were in forbearance still right now are asking for extensions, which means they're obviously struggling to keep up with their payments. So the pace of forbearance exits on top of that has also slowed to another low. So that means that the people who were in forbearance and exiting, there are less and less people exiting as we go on. So the people who are in the system, who are obviously are re-entering or asking for extensions, they are obviously struggling with their payments, which could be an indication of foreclosures to come in the future, or short sales as well, which means more inventory hitting the market. Just to reiterate one of the stories that we had last week's update, highest foreclosure activity since March of 2020, which should be no surprise as moratoriums ended. So a significant 139% increase compared to a year ago, and by 29% from a month ago. So those are significant increases, still historically low, but I believe with the ending of those moratoriums, as well as the fact that foreclosures usually take a long time to come to market, because even though a person might miss payments for a couple months, if they make one payment, it restarts the foreclosure process all over again. So it can be a lengthy process for those who continuously make, one payment every so often. It can really drag the process out over time. Looking at this is just a rent tracker for full month results. The key thing to take out of this graph is comparing the past 3 years, but you'll notice that the bottom number is circled 92%. So that is the lowest amount of renters fully paying their rent. So that means 8% of renters are no longer paying their rent or cannot pay their rent, which is the lowest it's been out of these months in the 3 years. So more people are stopping paying their rent, which could also be another indication of, the economy, inflation, people not having jobs, despite, we're supposedly at near full employment. I'm confused by that, because I still see, help wanted, shortages everywhere, businesses closing down. So I really don't know where this data is coming from. But, if you know where this data is coming from, or why I'm so confused, please leave me a comment and let me know. I'd love to find out why I can't figure this out. And then finally, I want to move on to the wall of worry, which is just the economic issues that are going on right now. What do we need to keep an eye on? One, inflation and hyperinflation. So, I think we're going to be seeing a number somewhere around 10%. Whether or not that's the real CPI data, that's up for debate. But I think the CPI data will be coming in somewhere around 10% this time. PPI data was already at 9.5 the last time we checked, which is usually a leading indicator of where CPI is going next. Because PPI is the producer price, which means they're going to be passing those costs on to the consumer, which will then increase the consumer price index. The other thing is Fed rates and mortgage rate increases. This is going to be an affordability issue as we continue moving on. If Feds do end up hiking the rate, which I really think they need to, with inflation being at over 7.5% already, even just increasing it 100 basis points to 1%, since we're almost at zero right now, that's still a 6% gap. So I don't think that's going to really help fight inflation until they start really bringing the rates up. I know they're kind of, they're teetering on the edge because they don't want to raise them too fast and put us into a deep recession or even a depression. But at the same time, it's looking more and more like what happened in the 70s. Despite me not being around, I still understand the forces and what the impact was. It took years to stop inflation because once it gets going, it's hard to stop, and you really need to raise the rates quite significantly in order to get it under control. The other thing to think about, stock market crashes and corrections. If you've been paying attention to the stock market, there's huge volatility in the market right now. I mean, we're seeing in indices 6% swings in a day, from -3% to over +3% in the S&P 500 in one day. That's not a healthy stock market. Things like that should not really be happening. So it kind of questions. I mean, I've heard a lot of different theories on why it's happening, but I know one of the arguments that people have been making about we're not going to see a housing crash or any type of stock market crash or anything. The housing market crash, people usually talk about the equity that people have built over the last couple of years, as well as the underwriting terms and how much more strict they are about underwriting mortgages now. The only thing that I have to say about that is if the stock market crashes and people lose half of their their retirement portfolio, those people who have vacation homes or secondary homes or even investments, they're going to end up selling those because they need to, what's the point of having them if you can't use them and you don't have the money to continue on the lifestyle you're living. So I would think that those frivolous expenses are going to be the first things that go, which could bring a wave of inventory to the market. If a wave of inventory comes to the market, people might panic. They might feel like they bought at the top, and then it could become a race to the bottom. It's not going to be hard to really flip the switch in this, hysterical type of market and economy that we live in right now. If we're seeing 6% swings in one single day in the stock market, those same type of psychology can happen in the housing market too. So that's something to be careful of, and watch the stock market. Bear market and recession, if that does happen and we do see stock markets start to plummet, the thing to look for is job losses. If people are losing jobs, that means foreclosures and SEOs are going to be, REOs are going to be coming to market. It means more inventory flooding the market, which means people could end up getting into that, snowball hysteria of race to the bottom. And then the other thing right now is the Russian sanctions. We really don't know how it's going to play out with the SWIFT sanctions that they have, but as well as the commodities, wheat, oil, palladium, nickel, raw nickel, all those things are huge exports of those countries over there. And those supply chains are going to be disrupted, as well as, whatever these sanctions might do economically, and whatever sanctions or counter sanctions Russia might put on, on Europe, as well as the U.S. So these are all things just to keep in mind. And, this is just my thoughts about the market, but, I want to know what you think. So let me know in the comments below what you think about the markets, what you think about my analysis, and where you see things going in the future. Thanks for watching. And if you enjoyed this video, please hit that thumbs up button to let me know. And don't forget to register on my site to get access to loads of exclusive tools, data, and content like foreclosure and open house lists, buyer and seller guides, calculators, and access to our Southwest Florida MLS. If you have any questions, please don't hesitate to give me a call or send me a text at 239-310-5478. And if you prefer email, you can send one to rick@swflrelocationteam.com. Thanks again for watching to the end, and I hope to see you next week.